Hello everybody, my name's Rick Spooner. Welcome to this CMC Markets update video where we review the traders week ahead. Well, we head into this week with the US government being in shutdown mode. This is not really expected to have much impact on markets, particularly because the question of the US debt ceiling and therefore any question of default on the US debt is not in question this time. Nevertheless, the market is a little bit unsettled by it this morning, I think. We've seen a bit of a downturn in US futures this morning on Monday morning, and in addition to that, our stock index market, the Australia 200 here, is probably a little weaker than many anticipated it might have been after quite a good session for the metals markets and the US index on Friday. One of the other possible impacts of the shutdown, though, is that it could delay some of the economic statistics due out of the US later on in the week. Leaving aside the question of the shutdown, though, we head into this week, of course, with some strong trends continuing, none less than in the US stock indices. So certainly looking, for example, at the chart of the S&P 500 I've got here, you can see that we've really had no sign of any pullback now for quite a while in this trend, which just keeps on pushing higher. That leaves us in a situation where we are quite a long way above now some of the short-term supports. You can see on the index there that we're quite well above the 10 and 20-day moving averages, for example, as well as the nearest of the trend line support. So for trend followers now at this stage, it's really just a matter of waiting to see whether we get some sort of minor pullback into that 10 and 20 trend line sort of a zone, and the market settling down there for a possible buy opportunity, or whether when we do eventually get a pullback, the market keeps falling and it might be something a bit larger, but all that's for the future, of course. Possibly the key driver of US and I'd suggest world stock markets at the moment is the US reporting season, which is now well and truly underway. Market expectations are very strong according to Reuters. The consensus expectation is for this quarter's profit, the fourth quarter 2017 profit, to be 12.4% above the 2016 profit levels. One of the main drivers of that will be the energy sector, driven by the healthy increase we've seen in oil prices, and all that 12.4% gain, of course, comes before the US tax cuts become effective, and certainly one of the other things markets are looking for is ongoing positive commentary from major companies about the potential impact of the tax cuts on their future profitability. So the profit reporting season will really get right into full swing this week. Already, as you can see here, we've seen 53 of the 500 stocks in the S&P 500 reporting, and of those, 80% have reported or a beat of expectations on earnings, and that beat is averaged around about 3%. Now the average for beats of analyst expectations is about 60%, so already things are at a healthy stage as far as this reporting season is concerned. This week, though, we're going to see a big raft of companies reporting. So looking at the US 30 index, the Dow Jones index, you can see that 9 of the 30 stocks in the Dow Jones will report this week. They include, amongst others, Johnson & Johnson, Procter & Gamble, General Electric, Caterpillar and Intel. So some big reports coming this week, and what happens there, I think, is going to be one of the key drivers of that trend or ongoing uptrend in the US stock indices that we've already looked at. Another feature of markets that I think really bears watching at the moment is the quite concerted downtrend we are now seeing in long bond prices, or put another way, the uptrend in bond yields. Now, this is going on in quite a few of the major markets around the world, particularly in the US and Australia, and I think it really reflects the same sort of thing that's been driving stock markets. That is, markets are reacting to the outlook for improved economic growth in 2018. So now there are a couple of aspects of this. One is, of course, the just outright trading opportunities potentially in the bond market. I featured the long bond chart here in the chart forum a couple of times last week, and as you can see, traders got this nice opportunity to sell bonds, or put another way, position for rising yields on this retest of the old support here. And that does create the possibility that this long bond yield in the US could continue to head down, possibly towards previous support levels, and these AB equals CD levels around the 147.20, 147.70 sort of a range. Equity markets are not really too concerned about the rising bond yields at this stage, certainly at these relatively low levels still of yield. In Australia, for example, the 10-year yield is currently up around 2.88%. That's quite a significant lift in recent weeks, but is still short of the highs we've seen in since 2014 and 15, and broadly speaking, the 3 to 3.15% range. And I think possibly it seems to me that unless we really broke up above that 3.15% range for, say, the Australian 10-year bond yield, that the equity markets might take this in its stride. But certainly I think just something to keep an eye on here, to watch the US long bond yield charts, 10 and this T-bond chart on the platform, just to keep a weather eye on it and make sure that it really doesn't start to break down through these major supports, because that could have quite an impact potentially on stock index and currency markets. So talking of currency markets, we've seen some strongly trending markets there as well, of course, in 2018 so far, mainly centred on weakness in the US dollar, and there's been no stronger trend really than the uptrend in Aussie US that you can see here. And you can see the real similarity between this and that very powerful uptrend in the S&P 500, where it's been a pretty much unbroken trend, and that's really seen it quite extended now, well above the 10 and 20 day moving averages. Now, that doesn't mean to say it won't keep going, but it just does mean that if you're not in this trend now, it's a matter of possibly of waiting for some sort of a pullback, potentially into at least that kind of a zone. And once that pullback gets underway, then again, like the stock market's just assessing whether it's going to be a minor pullback into that 10 and 20 day moving averages, giving us another buying opportunity, which you can see we had one of those opportunities quite recently, the pullback to the 10-day moving average here, or whether this time round it just keeps falling and creates a more powerful uptrend. Now, as far as the currency markets are concerned, I suspect that the main thing that markets are going to have on their watch list this week will be central bank meetings, specifically the Bank of Japan meeting, which will be on Tuesday Australian time, and the European Central Bank meeting, which will be on Thursday evening Australian time. One of the key contributors, I think, to the weakness in the US dollar and this ongoing downtrend we've seen recently has been growing confidence about the outlook for growth in Europe and Japan. And that's really got the markets thinking that the ECB and Bank of Japan are really getting into the same sort of position as the Fed is. That is, that the economic growth will probably allow them to start winding back their monetary stimulus a bit without doing much harm to growth. Even if they don't get inflation, they can probably just begin the process and take a few baby steps without harming the growth level now that it's got to such a good level. And that's a bit of certainly an advance on what people were thinking of for either of these countries a while ago now. That doesn't mean to say that any change is imminent, but certainly the markets are going to be really focusing on the bank meetings now for any discussion about how well the economy is going, or in the case of the ECB, the beginnings of talking about the next step, which would possibly be to reduce their current levels of quantitative easing, purchase levels of 30 billion euros per month from the next self-imposed deadline that they've got, which is at the end of September. So watching brief there. Now, this is one of these weeks when there's really very little in terms of economic data, as far as I can see anyway, that seems an obvious candidate for having much of an impact on currency or stock markets. The main one, I suspect, will be the release of the US GDP data, which is due early on Saturday morning Australian time. There the markets are looking for a solid 3% gain, a 3% per annum gain in GDP. Better than that would be potentially bullish US dollar and stocks. Worse than that, or significantly worse than that, potentially bearish US dollar. But as I say, at this stage, there's a little bit of a cloud over this data with the government shutdown, and it may be that if that continues, it will be delayed because of the civil servants not being around to do the sums required. Thanks for joining me this week, and good luck with your trading.